So what's going on, guys? I'm back with a new video. So this time I'm going to talk about the volume profile for the first time on this YouTube channel. So actually I'm going to talk about a strategy that I call the basically the gap fill reentry. It's really a strategy that I like because it's pretty simple, but what I saw with other people talking about it with volume profile, market profile, they don't really talk about context. So really I'm going to give my perspective on that. And how context is really important for volume profiling. So first of all, what I'm going to do is that I'm actually going to show you guys what is a gap and basically how to play it. So if I So first of all, I'm basically show what a gap is and what it involves, because obviously it's extremely important and not everybody really properly understands that. Well, it's really simple. So a gap is essentially, let's say this is your day one, so you have a distribution here, and then let me actually do this a bit bigger so you guys can see. So this is your first day one distribution. I'll call it 1. And basically, in order to create a gap, it's pretty simple. You basically open, so let's say you open here, you basically open out of range, so like that. So this is your opening. I mean, this is not really a distribution, it's just, let's say you simply have the open here. Obviously it can be on the other side, but for the sake of this video, I'm just going to do it to the upside. So a gap, as I said, is simply opening outside of the previous distribution range. So this is basically your day 2. So now, a gap is not simply this out of range opening. It has really some, I would say, important implications. So first of all, when you see a gap, the first thing you gotta think is, okay, I'm in the gap. All of this positioning that was created here, so all of the participants that were basically facilitating trading here, we'll see the price at, so let's see, this was a price, I don't know, of 10, and now it's a price of 15. Well, all of these people basically panic, and this will create natural positioning when we're opening out of balance. And this basically these people who are panicking and create this positioning will, as a consequence, we will most likely see a very, very volatile range, or it can be an expansion to the upside or downside, but I'm going to talk about that a bit later in this video. But as I said, so number 1, the gap will create volatility. You're going to write it like this, volatility. And number 2, it creates positioning in the market. So basically, all of these guys that were here, let's say if these guys were long, well, they won't really be panicking, but people who were short here and now are seeing this opening here, well, if this starts going towards the upside, they will really start panicking. On the other side, if these guys who are long here will start to see the gap filling, well, they are most likely going to liquidate. And by the way, I should note this. When I'm talking about these guys, it's most likely not LTF, so long-term time frame participants. It's most likely short-term day traders, speculative algorithms, and basically all of the price-sensitive participants that are most likely going to liquidate on these types of short-term moves. Because if you talk about, for example, an LTF participant such as a bank or an institution, a bank will most likely not liquidate its entire position or a partial position because we basically opened 5 points above it. They don't really care about that because they're really focused on the long term. Plus, they have massive amounts of capital, so we're not really focused on that. We're really focused on these price-sensitive participants. So these are basically our 2 implications. Also, one thing I have to note about this is that, as I said, we open either above or below range, but you cannot really, this doesn't apply for extremely large gaps. So for example, we have a distribution here, we have another one here, and the difference between this settlement and this open, let's say, I don't know, on ES, on the S&P, it's 50 points, which is quite a massive gap. Well, in that case, this strategy and in general gap rules will not apply. We're not, well, most likely gonna see volatility, but all of the liquidation of positioning and even volatility, it's not really sure that it'll happen. And this is simply because the odds of filling a massive gap such as this one are much smaller than I would say a regular gap of a few points, or like this one. So basically when you see a super large gap, basically gap rules do not apply. So yeah, I just wanted to note that because in the past I got trapped on massive gaps and are still pretty hard to trade for me. I'm still developing strategies in order to trade them. But usually what you'll see, it's not really the topic of this video, but let's say this is a massive gap, you'll most likely see a distribution like this. Sometimes if it really fills in this gap, even though the probabilities are not really in its favor, well, in that case that will be an anomaly, and the next day we'll most likely want to play towards the upside in this case. But again, this is not really the topic of the video. So right now we're really focused on this gap fill strategy. So now that I basically walked you guys through how to identify a gap and what it implicates, I really want you guys to focus on this right here, which is positioning, because it will be extremely important in basically the strategy that I'm talking about right now. So as I said, now that you know what a gap is, I'm gonna walk you through the basically step by step how to apply the strategy, how to find it, and how to trade it. So I'm gonna do it step by step because I see a lot of people on YouTube doing it. They kind of explain it, but not really in a I would say step by step manner, and it's a bit complicated to understand. So that's why I personally, when I create a strategy, it's kind of an advice, but not really an advice. I would say a tip, because I can't really give you guys advice. It's like just do like 1, 2, 3, like what happens, what you want to see in this type. Well, if you do this, it will be much easier to trade the strategies and respect the strategies you have developed or you have learned. So the first thing. So let's say this is our day 1. This is our day 1. And this is our day 2. So this is 1 and this is day 2. So obviously the open in this case is right here. So let's say this is a regular gap, no massive gap anomalies, gap rules apply. So again, boom, first thing we see, boom, we know that positioning is created in the market that may be vulnerable to liquidation if we go to most likely towards the downside because we gapped up. So positioning and volatility. Most likely you're gonna see volatility in this type of profile. So the first rule of the strategy is that let me actually draw this in green. So the first thing you want to see is we want to see the gap fill within the initial balance. So number 1, gap fill. My bad guys, I can't really write with this mouse, but I hope you guys understand. Gap fill within IB. So when I say IB, it's basically initial balance. So if you guys are not aware, the IB is basically the first hour of trade, so the first 2 periods, meaning A period and B period. So this is the most important part. We really want to see the gap fill within the initial balance. So by the way, the initial balance will most likely be depicted on your profile, and I don't know what color. Mine it's blue, so like that. So this, we really want to see this gap fill within basically the initial balance. Now, if we want to play this strategy, we really want to see multiple, and I really emphasize this word, multiple, basically multiple elements, or I would say variables of favorable FAV. I'm just going to FAV context. So we really want a favorable context. I'm not really gonna focus on this right now. I'm gonna talk about it when we actually see live examples. I'm gonna replay some charts with some examples that worked and some that failed, and you're gonna see why context is extremely important, because you basically do not want to go against, as people say, against the trend, but it's not really that. It's against, I would say, you don't really want to go against the highest probability trade. So this is our number 2, multiple variables of favorable context, and well, it's not really for now, but when we will be looking for the re-entry within either the range or the value, or I'm going to talk about this when I actually go over the 2 types of variations. Well, we really want to see high volume. High volume is extremely important. And why is that? So on most of my kind of breakout or re-entry trades, are really, this is like, I always have this. High volume is extremely important because high volume means that it's new business coming into the market. Participants are really initiating positions in the market, and it's not simply old business. Well, it may be also old business liquidating, but it's most likely going to be new participants and not old business such as stop losses or short-term participants. It's really initiative going on in the market. We don't really want to see responsive type of price action and this type of scenario. So once we have all of these all of these three factors. So one, we fill the gap within the initial balance. Two, we have multiple variables of favorable context. I'm going to go over that a bit later. And then we have a high volume on the re-entry, but again, this is not really in place here, but just remember these three. So feel free to screenshot them if you want, because I'm gonna go over the two strategies right now. So let me actually erase all of this. Okay, so once you have all of those three variables, now we can actually focus on, I would say, the legit strategy, the real strategy. So, the first type of strategy, I would call this the previous range re-entry. So obviously the range is simply the extreme of the previous distribution. So this is our first distribution right here. It doesn't matter how it is, just first distribution. And then we have our trade location open right here. So right now what is important is the distance between this extreme and the extreme of the value area, which I'm gonna draw right now. So let's say our value area is like this. So you'll notice that for us to take an entry on the extreme of the range and not the value area, we have to have a bit of a significant distance between this in this case this top extreme and the first extreme of the value area. So why is that? Well, it's kind of a simple answer. First of all, I'm just gonna write here down I have a significant, not significant, I would say an okay distance between the top of the value area and the basically the top of the previous distribution extreme. So you must have a bit of distance. And why is that? Well, when you're looking to actually take a short, for example in this case it's short right here, your first target will be this, so it's basically the top of value area. So let's say if it's 2 points, well in that case it's not worth to basically enter on the range extreme, but rather the value area. But this is the second strategy, but I just wanted to note this in case you guys are wondering. But there's another really important thing before I really talk about the step-by-step process. When you re-enter the previous distribution, whether value area, range, but most likely range, because yeah, well in that case remember what I said, gap is positioning plus volatility. So all of the positioning that was created right here, if when they see these prices getting down, all these people will have stop losses, but most stop losses will be right here when we close the gap. So in that case, it will create well, I would say a massive initiative liquidation towards the downside. So that's really why I was focusing on positioning that much, because all of this positioning will see stops, 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 and boom, here we have the most stops, and boom, this will create liquidation. And on top of that, we'll mostly have new business coming into the market, which will create a pretty high probability trade if we trade it properly. So now that we have that in mind, and we know that we must have a pretty significant distance between our top of range and value area, well now what we'll look to do is basically take a short here at this price level, aiming first for the top of the value area. So the first target is the VAH, and then our second target is VAL. However, I would also note that POC is an important target, if it cannot really go past POC, it's most likely not going to test that value area low. So yeah, if it's really struggling to basically see if it's taking too much time, again, time is an important variable. If we take too much time to initiate beyond POC or beyond value area high, well, in that case the initiative is not as strong as it seems, and either you take profit or you basically move your stop to a scratch, so at zero to break even for a risk-free trade, and you basically wait and see what happens. So this is the first scenario. Basically take a short on this top of range extreme, and these are your targets. However, there is one thing I must really talk about, but first let me actually draw this right here. So you want to take a short, long, basically initiate a trade on range extreme, and obviously these are your targets: the value area high, the POC, and the value area low. So alright, and one thing that is extremely important is that this particular range reentry only works if your basically re-auction reentry in previous distribution happens within the IB. So this is really important. When I backed the strategy a while ago, I found out that when you're taking your position off the extreme, you really want to see it happen within initial bounds, because that means that the all of this liquidation of positioning will be even more aggressive. So yeah, you really want to see it happen within the initial bounds. So again, you want to see basically the gap fill within the initial bounds, but also you want to see your entry, basically your trade, happen within the initial bounds. So so this is the first target. Again, I'm going to recap it real quick. So basically, fill the gap within initial balance. You have all of the variables we talked about, so context, high volume, and the re-entry, and then you look to initiate a position right here on the extreme of the top range. Then you have all of these targets right here. However, you want to see your entry happen within the initial balance, basically. So this is basically the first strategy that we're gonna go over. Now there's another variation of the strategy that I'm gonna go over real quick. Okay, guys. So now I'm gonna talk about. Basically, I'm gonna talk about the second variation of the strategy, which is the value area reentry. So if I just draw these distributions here, blue and yellow. So this is our day 1 again, and this is our open on day 2. Obviously, as I said, it can occur either to the upside or it can occur to the downside, but it's the exact same thing, but just vice versa. So again, the same rules apply. We want to see this fill, basically the gap fill within the initial bounce, which will create panic within the positioning created that was out of range. Obviously, we want to see volatility as well. But this strategy will basically come into play when the distance between the top of range and basically value area high or value area low, if you're trading to the downside, is really narrow. So in this case, as you can see here, this is really not a really small distance, maybe 2 points. I don't know, I'm just inventing, but obviously not really a massive distance. So when this happens, you want to apply the exact same process. However, you want to do something, is that you want to take your trade on the top of value area high, and this trade will actually give you a bit of a higher probability than the range trade, because the range trade can still see some responsive participants getting into the market, but this is a bit of a better trade if it happens. Obviously, it's not really gonna happen all the time, but it could happen occasionally that you can get your entry off the value area high. And in this case, your only target, at least your first target, will be the opposite extreme of value area. So in this case, if we're taking a short of the high, we'll basically look to get our profits at the at the value area low. So again, narrow distance between obviously the top of range and the value area high, and then we're gonna wanna initiate our positions on the value area high. I mean the closest extreme, I'm just gonna write here value area high, but it can be a value area low if your trade location is right here. But obviously in this case it's towards the high. And another thing I really want to note is that, as I said in the other strategy, basically it technically can only happen within the initial balance, but this strategy can happen at literally any time. So, for example, if your distribution is like this, or even like this, and this is your second day, so then we fill the gap within the IB, and let's say the distance is high. Alright, the distance is pretty large. Well, in that case, you would most likely want to get a range reentry. But let's say it doesn't break the top of extreme within the initial balance. So as a consequence, the first strategy becomes invalid. However, let's say later in the day, so I don't know, maybe L period, E period, I don't know what period, it comes back down and it enters your value area. Well, in that case, you can apply this strategy. It may be a bit complicated to understand, but this is what I noticed when I was backtesting. So yeah. But obviously, this is kind of an awkward case right here. But yeah, obviously, it can happen in this scenario as well. So for example, we fill the gap, we don't get our entry, but we get it later in the day. It can obviously work. You can take your entry and can target the value area low. So these were the basically theoretical examples, as I call them. I hope you guys understood. Obviously, if you have any questions, feel free to join our free Discord down below. You can ask questions regarding futures, forex. We kind of trade everything there. So yeah. However, now I have a few practical examples for you guys that will also basically bring context into play, which again is extremely important within the strategy. I'm gonna say it straight ahead. If you do not have context, your probabilities of succeeding with the strategies are much lower. You can succeed with the strategy, you can make profit with it, but your probabilities will be much lower if you do not have proper favorable context and multiple variables of context. So actually, I'm gonna take you guys a bit back in time. I took some examples from July. So we're gonna set this speed a bit lower, and then there you go. We're just gonna wait for the chart to load, and we're gonna bring this back. Okay. By the way, don't really mind these references right here. They don't really matter much. I just it was for something else. I mean, it's my usual references. So just note like the blue lines that I'll draw. Those are important, but the others are not. So again, first thing we want to see, we're out of balance. We're out of balance, out of range, basically, meaning we have a gap here. We have a gap of about, if we look at it, about 3 or 4 points. Well, but yeah, about 3 points, I would say, or 4. So what does that mean? 1, it means positioning is created in the market. Number 2, it means that volatility is created within the marketplace. So now, second thing you want to see is the distance between this top of value area and the extreme really large. Well, in this case, if you look at it, it's about 2 points really. It's not much of a distance considering like the previous 4, 5 ranges. It's not really much. So in this case, we really want to apply the second strategy. Now, so now that we really understood the strategy, obviously we would like to see high volume on this chart right here when we're getting the reentry. Okay, so as I said, the distance is really narrow between these two. So right now I'm gonna play this and we're gonna see how it works out. But first of all, I'm gonna go over the importance of context. So in this case, is the context pretty favorable, or rather not favorable? In which case we don't really want to apply this strategy. Well, you basically want to look at the past 3 or 4 profiles. Just look on what is on my screen. Are there any weak references? Are any basically points of attraction? Is there anything? So in terms of deprecating factors, well, the only, I would say, massive downside, well, non-favorable context variable is that this was a bracketed market and now we're basically back inside of it. So if we don't see initiative back out immediately, well, in that case the ultimate destination will become the high, but I'll talk about that later probably in another video regarding bracket rules. So this is one variable, and the second one is that we have a lot of pretty prominent POCs here, not most prominent, but as we know, high volume areas attract prices short term because that is where the most amount of trade facilitation occurred. So these are non-favorable context variables. However, now if we look at favorable context variables, we can see that yesterday, well, actually the previous session profile, well, it kind of initiated really out of this bracket. Even though the close was not the strongest, we really expect further initiative toward in this direction. So this is our first favorable context variable, and our second one is that basically, as you can see, value area shifted lower. So when value area basically shifts lower, it means that participants are accepting prices lower. Essentially, so basically that's it. Participants are accepting price lower. But if you have absolutely no overlap between your past two value areas, that means that it we're most likely one time framing, meaning that we took out the low of the previous session and not the high. So yeah, it can be towards the high, but that would be towards the upside, whatever. And the most significant factor, I would say, that really convinced me to take this trade is, as you can see here, this poor low. So what is a poor low? A poor low is essentially an incomplete auction, and it is depicted by one TPO of excess. So in this case we have the I, it's one TPO of excess, and it usually means that the market got too long or too short. And it's really hard for the market to move away from these type of incomplete auctions, poor pivots. It can move away from it, but obviously it's an anomaly, and the market will be most likely attracted by it and will look to repair it. So now let's draw the references. We have our value area high, we have our value area low, we have the POC, but as I said, when you enter on the value area high, you really want to look for this value area low, and then if the initiative can continue beyond this value area low, well, this will be our final target, which will basically result in about 30-point trade or a bit less, but never mind. So now I'm gonna speed this up so we can see it. Oh, by the way, I should probably draw the same line here so you guys can see it. Yeah, I think this is fair, like that. Okay. So when we re-enter this line, we really want to see high volume. As I said, let me speed this up a bit so we can see the break and the re-entry faster. Okay, so right now we're starting to see initiative towards the downside. The volume is pretty consistent, as we always have when basically open, and boom. Now let's see how the candle closes. If it closes pretty strong, we'll look to go short on this candle. Boom. It really initiates towards the downside. Look at this volume. This is really nice volume. This is the type of new business initiative we want to see. So at this point we would be short. So again, right now what we're seeing is new business coming into the market, but also all of this positioning up here that is getting basically liquidated, which should further accelerate price. So let's say we entered here. We could go ahead and place your stop, let's say at 62, 61, even 61, just above the previous range, which is a pretty good structural stop. When you can get these types of stops with low risk, just go ahead and place them. So I'm gonna play this. Let's see how it works out. So right now it looks like, okay, we bounced a bit, some responsive participants, and boom, we're already going down. So let's see, I'm just gonna forward this to see if our targets got hit, and as B opened, It's not the strongest initiative, but volume is extremely consistent. And there you go. Our first target just got hit, and this happened in a matter of a couple of minutes. I would say half an hour or so. Now let's see. Can we really sustain the initiative beyond this pivot? If we can, and yeah, we just did. Look, we just took it out. Basically, in 5 minutes, we took it out, and we really want to see this area right here get tagged, possibly the poor low getting taken out, and that will be our trade for the day. Okay, so right now CPR is trying to come back into previous value area. So let's see. As you can see, it could not really hold. It could not really re-enter, which is a good factor for us. And if I split this up, you guys will see that we're actually one time framing, because obviously we took out the low. Mostly going to take out the low here, because again, look, intraday we left a poor low here, so the market is most likely going to come and repair it, at least by the end of the day. So let me actually fast forward this, see what happens. So boom, deep here just took out our first poor low. So actually, one other tip I can give you guys is when you have, for example, one poor low here, one poor low here, so two extremely weak references side by side, there's a much higher probability to take out at least one of them, and mostly the two of them. So just so you guys can just to note that. Alright, so let's see if it works out. Let me fast forward this. At this point you could have got out, because this is just two time framing, so there's really, I would say, trade facilitation here. We're kind of mean reverting with low volume, so it would be fair to get out near the low of this range. So let's see what happens if I fast forward this. Really, boom, let's see, and there you go. Our last target just got hit for a pretty nice trade, I would say. So yeah, so this was our first example. Now I'm gonna go over a second example that involves the first strategy, and then I'm gonna show you guys one last example in a case where it didn't really work out. So I'm gonna go ahead here. It's again, these examples are on ES, so it's on the 15th. I'm sorry, 6th, 15th. Okay, there you go. Boom, and I should pause this immediately. Oh, my bad, guys, I just missed it. Okay, let me actually show you guys this. Boom. Does it work? Oh, my bad, I'm actually 60 minutes behind, so looks like I'm gonna have to wait for a second. Okay, let me skip. Okay, there you go. There you go. So this is your really it's an extremely small gap, but it's still a gap. So again, if we go here, let's see whether it's a gap. Yeah, it's pretty much a 1 point gap, not even a few ticks of a gap, but it's still a gap. It still has positioning, and it basically still has all of this volatility you want to see. So again, now the first thing we want to see, what is our entry? Basically, what is our entry reference? Well, in this case, it will most likely be any initiative below this range extreme right here. And why is that? Well, this is because, as you can see, this is pretty significant distance between basically between the top of the extreme and the value area high. And what are our other references? Well, we have another reference here. Didn't really talk about this, but in this case we basically have a spike. So the spike base here, which is right here, will most likely it may act as support or resistance, but in this case it's support. So it's pretty important to note if we can't really see initiative beyond this. I would say if we take this out, I would put myself at entry, so it's pretty clear we have a winner, or at least a break-even trade. And then obviously our first significant target is the value area high, POC, and then we have the value area low. So now let's see how it plays out. Again, if we take too much time on any of these references, I would get out, or at least these downside references. And now let's go over context. So is context favorable or not favorable? Well, the first thing we kind of noticed here is that first of all, for example, we have a failed POC here. So why is that? So for example, look at this price right here. Look at where it closed, and look where the basically the value area and the POC is. It's at the completely opposite extreme of the profile. So these longs right here, it's kind of another topic, but it's pretty. I love these types of setups. It's really a massive favorable factor for us. So yeah. So obviously all of these longs here are long in the holes, or they're long at really bad prices, and they're really extremely vulnerable of getting liquidated. So if these guys will see the prices going down the following session, they will most likely stop out, which will accelerate price further, which will actually give us a double positioning, pardon me, a double liquidation of positioning, because we have the gap positioning and then we have all of these longs. Furthermore, you guys cannot really see this because I don't know why my chart is blocked here, but there was previously a bracket before this profile right here. There was a bracket, and basically if we re-enter in that bracket, that will mean that the opposite destination becomes the low, and basically overall we can also note that there might be a weak low here, but these are really our two main downside factors. And let's see how this works out. So I'm actually gonna play this 60 speed, and there you go. This is there is our entry. We initiated it here. So anywhere, obviously somewhere here would be a good entry for us. And let's see whether or not we manage to take out one of our references. So we have pretty strong volume as of now. However, we're already starting to see some responsive activity, which is not the greatest thing, but let's see how it occurs. Let me actually fast forward this a bit, and there you go. So we took out the spike base. If we sustain trade below the spike base, we're mostly going to set our stop at entry, and we're going to look for these references to get taken out. So let me actually split this up. Boom, just like that. So really kind of struggling at this spike base, but there you go. There is our first significant reference. So right here, if we see too much two-way trade and basically we're two time framing, we're gonna get out. But right now it's really trying to initiate lower. Let's see how it goes. There you go. It initiated lower, so we're still one time framing. We might actually leave some single prints. So single prints actually depict directional bias in the market as well as change. So single prints are obviously an extremely good strength control variable. On top of that, we have an open drive because we just we just initiated down, so that's a good variable as well. So let's see how it plays out. E period again. We're starting really to see volatility contraction, which is not the best thing, but again, look at E. E came a few ticks from our I wouldn't say our front target, because our front target is at a low. So let's see what happens. In this case, it left a pretty strong auction tail, so I'd be pretty careful in this type of scenario about where you take profit. So let's see how it plays out. So in this case, it would be fair to take any type of profit within the excess tail, I would call it, but let's see if it plays out better. So okay, no, it didn't really play out better. So in this case, it would have been either you had your TP a bit above POC, as you saw. Basically, basically it left massive excess tail, which is another strategy. That's why I kind of have a hard time explaining it to you guys right now, but this could have been a pretty good long here, even though this is a trend day. I mean, I would have taken a long, but it could have. Some participants may have gone long off the E excess tail, which is a completed auction. So the market has no real reason to actually trade back here within this day. So look, to prove my point, I'm just gonna fast forward it. So as I said, look, it didn't really come back to that E low there. It really started two time frame around the main. So yeah, so this is another example that worked. But now I'm gonna go over a setup that failed. It's actually in the Nasdaq. So let me actually go ahead and replay the specific date. So it was on the 12th of July. Okay, there you go. So let me actually split this up if I can. Yep. Alright. Okay. Okay, so first of all, let's just remind ourselves of the rules. We want to see this fill within the initial bounds. Obviously, in this case, we don't really have a top of range because it's immediately value area. But let me actually just play this, and I'm gonna give you guys a bit of time to think about it, about why it didn't work despite the high volume that we just got here. Despite all of the basically factors that work, I'm gonna just give you guys a bit of time to think about why it didn't really work. So I hope you guys thought correctly. So this didn't really work. Actually, it doesn't really show that it didn't really work yet. Yeah, I mean, you could have gotten a few points out of it, but as I said, it's not really worth it. And most likely got stopped on this job right here. So yeah, look, yeah, it's basically you would probably gotten stopped out here. So why doesn't this work? And again, it's pretty simple. It's purely context. Context in this particular scenario was not in our favor. So why do I say that? Look at the past two profiles. We had open test drive with excess tails toward the downside. So that means that these auctions are complete, and we saw massive strength from really aggressive, responsive buyers that responded at these prices, and basically liquidated all the shorts that were here. On top of that, we have other factors. We have the value area shifting higher, a value area with really minimal overlap. So that means that the market is one time framing. Look at these types of closes and where the POC really migrated towards the top despite the aggressive move. This means that value is really accepted towards the high despite this really strong initiative here. And finally, I would say the most important factor is that if you look at this, what are these? This is a massive low volume area with single prints. And if you recall, I said that basically single prints and low volume areas will eventually get turned into high volume areas. However, in the short term, initiative participants will look to defend them because they basically mean change and directional bias, in this case towards the upside. So the simple fact that didn't let this trade work out was context. So this is why I really emphasize on it. So that's it for me today. It was a bit of a long video, I guess, but I hope you guys learned something from it. And again, don't really feel free to join our free Discord. Feel free to join our free Discord. So obviously, we're really trying to help people out. Other people help us, obviously, because we're not the best traders in the world. And yeah, obviously we have people that post charts, analysis. So yeah, it's a really cool environment if you guys want to join. And feel free to ask questions in there. I hope you enjoyed, and